Trading in any financial market is extremely challenging, as shown by the fact that the majority of new traders lose money. Success can be attained nonetheless if one has the necessary training, experience, and practice. With daily exchanges of $45 trillion in notional value, the currency market is the largest investment market in the world, and it is still expanding. In contrast, the New York Stock Exchange, NYSE, only sees a daily volume of $25 billion. The market may be vast, but until recently, professional traders accounted for the majority of the volume. However, as currency trading platforms have advanced, more retail traders have discovered that Forex is a good fit for their investment objectives. So in today's video, we will tell you all about Forex trading. This video will surely work in your trades. The market for trading foreign currencies is known as foreign exchange trading, Forex trading, or FX. The world's largest market, Forex, influences everything from the cost of apparel purchased from China to the price you pay for a margarita while on vacation in Mexico. A trader buys one currency and sells another, and the exchange rate is continuously fluctuating based on supply and demand. At its most basic, Forex trading is analogous to the currency exchange you might perform while traveling abroad. The foreign exchange market, a global marketplace open 24 hours a day, Monday through Friday, is where currencies are transacted. All Forex trading is done over the counter, OTC, which means that there isn't a physical exchange and that a network of international banks and other financial institutions, rather than a single exchange like the New York Stock Exchange, oversees the market. In the Forex market, institutional traders, those who work for banks, fund managers, and multinational corporations, make up the great majority of participants. These traders may only be speculating on or protecting against potential exchange rate swings. They may not be planning to take physical ownership of the currencies themselves. If a Forex trader thinks the dollar will appreciate and will be able to purchase more euros in the future, one might buy US dollars. In the meantime, an American business with operations in Europe could use the Forex market as a hedge if the value of the income generated there declines due to a weaker euro. Every currency is given a three-letter code, similar to the ticker symbol of a stock. Although there are more than 170 other currencies in the world, the US dollar is used in the vast majority of Forex trades, so understanding its code, USD, is very useful. The euro, which is accepted in 19 member states of the European Union, is the second most popular currency on the Forex market, sign EUR. The British pound, GBP, the Australian dollar, AUD, the Canadian dollar, CAD, the Swiss franc, CHF, and the New Zealand dollar, NZD, round out the list of other significant currencies. The two currencies being exchanged are combined in every FX transaction. The exchange rate between the two currencies is represented by each currency pair. Following is an explanation of how to understand that data using EUR-USD, or the euro to dollar exchange rate. The base currency is the euro, which is shown on the left. The quoted currency is represented by the US dollar on the right. How much of the quote currency is required to purchase 1 unit of the base currency is indicated by the exchange rate. As a result, the quotation currency varies depending on the market and how much is required to purchase 1 unit of the base currency. The base currency is always expressed as 1 unit. If the EUR-USD exchange rate is 1.2, that means 1 euro will buy 1.2 USD, or, put another way, it will cost 1.2 USD to buy 1 euro. When the exchange rate rises, that means the base currency has risen in value relative to the quote currency, because the euro will buy more US dollars. And conversely, if the exchange rate falls, that means the base currency has fallen in value. Although there is a historical standard for how some currency pairs are expressed, currency pairs are typically presented with the base currency first and the quote currency second. For instance, conversions from USD to EUR are shown as EUR-USD, but not USD-UR. The majority of Forex trades are performed to speculate on future price fluctuations, much like stock trading, rather than to exchange currencies, as you may do at a currency exchange when abroad. Like stock traders, Forex traders aim to either buy currencies they believe will appreciate relative to other currencies, or sell currencies they believe will lose purchasing power. The majority of Forex traders who want to speculate or protect themselves against potential fluctuations in currency prices use the forward and futures markets. The spot market, the biggest of the Forex markets and the location of the majority of Forex trades, serves as the basis for the exchange rates used in these markets. The supply and demand of buyers and sellers determine currency prices, just like they do in any other market. However, this market is also being influenced by other large-scale factors. Interest rates, central bank policies, the rate of economic growth, and the political climate in the nation in question can also have an impact on the demand for specific currencies. Because the Forex market is active around the clock, 5 days a week, traders can respond to news that may not have an immediate impact on the stock market. Traders must be knowledgeable about the factors that could lead to sudden increases in currency values because speculation and hedging account for a large portion of currency trading. There are more risks associated with Forex trading compared with other asset classes because it uses leverage and margin. Because currency prices fluctuate constantly yet in very small increments, traders must make huge trades using leverage in order to profit. If a trader places a winning wager, this leverage is fantastic because it can increase winnings. It can, however, potentially increase losses to the point where they exceed the original borrowing amount. Users of leverage expose themselves to margin calls, which could force them to sell stocks they bought with borrowed money at a loss if a currency depreciates too much. In addition to potential losses, transaction fees can mount up and reduce the value of a trade that was previously profitable. In addition, the Securities and Exchange Commission issues warnings about potential fraud or information that could be confusing to new traders. People who trade foreign currencies are like small fish swimming in a pond of expert professional traders. Even if the typical investor should generally avoid the Forex market, what happens there has an impact on all of us. The price we pay for exports and the cost of traveling overseas are both impacted by the spot market's live activity. Traveling abroad and purchasing imported items, such as vehicles and clothing, will be less expensive if the value of the US dollar increases in relation to the euro, for instance. On the other hand, as the dollar declines, it will cost more to travel and import items. It's all about today's video. Share your views in the comments section and also subscribe to the channel Trading Access.